Good morning. Welcome to Mindset Meets Mechanics Portfolio Considerations. Today we're going to go through the public portfolios, US and Australian, but we're also going to go through the Learn to Trade Properly study group public portfolios because they are being traded in the public arena. Now, obviously, the Learn to Trade Properly study group portfolios emphasize that they are for skills acquisition at this stage. And I'm going to point out one big key learning point, if you like, that out of these skills acquisition portfolios. So hang in for that, and you'll see it's quite obvious when we get there. Before we do that, everything we covered today is general investment advice. There's no specific or personal investment advice. Okay, the portfolios we're going to go through, the ASX portfolio, Sparsary Investor portfolio, and US unleveraged, been going since January of 2016, and the leveraged public portfolio, which I'll just show you an equity curve of and just talk a little bit about that as well. Objectives of these sessions, this is warts and all real world conditions, and we see how mechanical trading systems work if you execute them properly and flawlessly, Mark Douglas's words. And what we're also trying to do here in these Learn to Trade Properly study groups is to build functional trading habits that work. And a habit is something that's intangible. It's something that's in your mind. It's a mindset. It's building up different ways of doing things, new ways of doing things until they become a habit, and then they become entrenched. And we want to build good functional habits, and we want to overwrite and de-energize poor dysfunctional habits. And you can only do that if you are doing it in the real world. And that is what the Learn to Trade Properly study groups are about. And that is what the public portfolios have always been about. We've just added another level of intense training, if you like, and also accountability to actually pick up these habits. And we go through those portfolios, the Learn to Trade Properly portfolios in this session. Right, the ones that we've got going so far, the first study group portfolio we look at started back on 20th of September. That's an ASX. We'll look at a US one that started on the 9th of December. And then we've got an ASX and a US started the 3rd of February. And then we've also got an ASX and a US that started on the 31st of March, beginning of April, if you like. And I'll tell you now that there's the next Learn to Trade Properly study group. We'll start on the 2nd of June. We've got a good number of people that have already registered for that. I think around about 30 is the number. But there can still be more spots if you want to get into that study group. So let's have a look at the recent market conditions to see what we've gone through over the last 4 odd years, nearly 4 years. Or in fact, that is just about spot on, a month shy of 4 years. That is the US market, and it is up 21% from that peak that was achieved back here on the 3rd of January 2022. So from there, it's just over 3 years, coming up for 3.5 years from the extreme left over here, just under 4 years. And so that's 21.84% from that peak to current. Now, that's not current last night. It's a wee bit higher than that. This chart is the previous day's close on the US market. But the other thing I want to point out here is that this is what's called a breakaway gap. And that's quite key. That's strong price action. It doesn't mean there's not going to be any retracements in the short term, but typically what we look at now, a little bit of technical analysis here, is whether that gap fills on the downside or not. So it can retrace, but we don't want the gap to fill. If the gap doesn't fill on the next trough and then rises again, that's what we're looking for in the short term. This is the All Ordinaries index, and from August of 2021, it has, I'm just going from the peak, so it's not the same time, the same period as the US. I'm just going from when that first peak was achieved, which is obviously a different date to the US, and that's up 7.6%. So certainly, and it's been like that for some time, underperforming the S&P 500. In fact, just about a lot of managed funds and hedge funds underperforming the S&P 500 through this secular bull market. Right, let's just have a look at some relative performance on the ASX public portfolio. So this is the portfolio that's been going since January 2016 and to yesterday's close. And you can see here that the 15th, don't know what that date is over there. But anyway, it's up 14.5% from August 24 to current, and it's outperforming the accumulation index and the and the All Ords index as well. And this is to current. And this is the entire from inception public portfolio, which is the blue line, and the red line is the ASX 200 accumulation. So up 183%, the public portfolio, and stays above the All Ords or the ASX 200 accumulation index, which is total return, including dividends, 126%. So just looking at the relative performance. And here is the shorter time frame from June last year. We can see that is up. This is the US portfolio. So this is the one that started back in January of 2016. We're now looking at its relative performance since June last year, and it's beating the S&P 500, even though we've had this severe drawdown over here. And this is first lesson of today is that people get frightened off when this sort of drawdown happens. And of course, because of recency bias, they think what has happened in the short term is going to persist in the longer term. And of course, when there's red ink everywhere and we see sharp falls like this on the index, people get frightened. And it's an automatic response that we have to overcome. And it's our threat detection systems threaten bad things that we don't like to happen. And automatically, unless we overcome this through skills acquisition, we will make mistakes. We'll do things we shouldn't do. And so we have to have a benchmark, a true north, if you like, that keeps us on the straight and narrow, that we can measure how well we are doing from handling our threat detection systems, managing our threat detection systems that don't cause us to make mistakes. And so what typically happens in situations like this is somewhere around about the bottom over here, people have enough and they sell out and they say, I'm not doing this anymore. And of course, what they do is they miss out on the upside. And that doesn't mean there's no guarantee that it's not going to fall again. But we do know that with an edge, if you continue to execute and you trust your edge and you have confidence in it and you become consistent and you are objective to your edge, then that is when you start creating new neural pathways in your mind and you start creating new habits and you become objective and consistent and you get confident and trust your edge. So that is what we are trying to do. So let's take the learning from this drawdown period over here. I mean, there's one thing that I know will happen is that at some stage, we're going to talk about this in a little bit, in a few more minutes, is that we're going to make a new all-time high, which means we're going to take out this high over here. And that's the bigger picture perspective. Last week, I did the secular bull market update, is having that perspective, is understanding that that's going to happen, and not looking for short-term and instantaneous gratification. We're looking for delayed gratification by continuing to execute the process. Now, this is since September 2022. This is also the US portfolio unleveraged. It's more or less line ball between the index and the portfolio. 69.3 versus 67.6 for the S&P 500 total return index. And this is going back to inception, 12.1 for the public portfolio versus 13.9. And with that, and I won't go through it now, but as I said in the past, a couple of largest mistakes that have cost us around about 1 to 1.5% compounded over that period of time when we changed the number of open positions in the portfolio. Right, now looking at quickly the leveraged portfolio, had some sharp drawdown over here with the Trump tariff. There's the Trump tariff and the index over here. And we continue to execute the edge. We subscribe to not having to know what's going to happen next. We become comfortable with not knowing, and we continue to execute the edge. And we've had this run up from the bottom over here. So since September 2022, the leverage portfolio is up 263% versus the S&P 500 total return index being up 67%. So obviously bullish market conditions, even though we've had these dips along the way. Okay, some sells over the last month. Not that many sells because the last month we covered the sells that occurred with the Trump tariff turmoil. So they all happened prior to since we did one of these the last time we did the session. So in the ASX, just 2 sells, Evolution and Domino's, 1 small loss trade and 1 small profit trade. And on the US, just 1 sell, Vertex had a sharp end of trade drawdown, 2 big days, hit the volatility trailing stop and ATR trading stop, and we were taken out, and that was an average kind of loss, 7.63%. And that same trade was that same position in the leverage portfolio was the only exit as well. I'll go through these fairly quickly. Now and I'm going to look at the equity curves in a bit more detail, but I'll cover the sells first. The September LTTP, which is ASX, just those 2 sells, Evolution and Domino's, and relatively probably half the size of the average loss and a tiny profit. On the US, December the 9th, which is the second LTTP study group that we started, just the 1 sell, Vertex there. And on the February the 3rd, ASX, this is the next Learn to Trade Properly study group that started in February, and they started trading then. The same 2 sells. And on the US also, which started on that same day, also 1 sell, also around about 7%. And the ASX, the one that started on the 31st of March, so the beginning of April, that's the most recently started, only been going for just over a month and a half. Also 2 sells, the same 2, Evolution and Domino's. And the US one that started 6 weeks ago, thereabouts, no sells over the last month. In fact, no sells at all in that portfolio. We've only had buys in it. So we'll have a look at a bit of detail of how these portfolios are going. And at this stage, I want to remind you of what the first or the objective is of the skills acquisition plan that we do in the Learn to Trade Properly study groups. And so what we set out to do here, and those of you that have read Mark Douglas's book will know that in the back of his book, the exercise he talks about doing 20 or 25 trades or lots of 20 trades. And so 1 lot of 20 trades, another lot of 20 trades. And he does that, and you've got to do it with a mechanical system. And he doesn't specify whether it should have an edge or not, although mentally it does help if you've got an edge. And the idea is to really train yourself, do some experiential learning to gain the habits and the skills that he talks about in his book, Trading in the Zone. And we've modified that to actually have 2 specific periods that we aim at, and that is to have at least a 10% drawdown, but preferably as much as minus 15% drawdown, and go through 2 of those. So the first part of the objective is to actually get to that level of drawdown. So remember, we're doing skills acquisition here, and this is setting ourselves up to be to gain the habits that we need to be a long-term performer in the market and accept risks in the market. The first step to consistency is to accept risk, completely accept risk, truly accept them. And how do you know you've truly accepted? Is the risk is that there's absolutely zero internal conflict about the status of your portfolio or the status of the market, regardless of what the market's doing, whether it's going up or down. No internal conflict, no doubt, no confusion, no discomfort. That's when we know we've completely accepted the risks. And the second part of the objective is not just to reach the drawdown, but to continue executing your objective process to come out of drawdown and make a new all-time high, to achieve a new all-time high portfolio. So I'm reminding you of that because most of the LTTP study group portfolios have achieved the first part of that objective, and that is that they've got down to that at least 10% drawdown, bar 1, which we'll have a look at in a moment. So that's the objective. So let's have a look at the September LTTP study group. Started back then. The gray line is the equity curve of the portfolio. And the red line is the ASX 200 accumulation index, just to benchmark, see what the market's doing. In such shorter period of time, you could probably take out dividends and benchmark it against the ASX 200 or the All Ordinaries without dividends, because that gives you a better idea, if you like, of the movement of price in the cash index rather than the accumulation index. And what I've got here is an underwater curve, if you like. I've used a histogram. You can make this a line curve. And this red line here is the minus 10%. So there's the first part. Didn't quite get down to minus 15%, but we have achieved a sufficiently deep enough drawdown to feel those dysfunctional feelings, if you like, with respect to how you invest in the market, to feel the discomfort. And now the task is to trade out a drawdown. How will we know we'll trade out a drawdown? Well, you have a look here. See all of these, every day over here, we were making new equity highs. There we had a drop, and there that's on zero. So there's the zero line. So this is minus %, if you like, drawdown any given time. So we've achieved that. Now the idea is to get this orange histogram up here to the zero line. It won't go above zero because it's an underwater curve. And that when we do that, the September LTTP study group would have achieved the first of those drawdowns and come out of them. Now, we've got customers that have been with us for nigh on 30 years, and they've been through this many, many times, and with lots and lots of money. And that's why, because they've got the skills. They've got the skills. They don't feel that discomfort to the degree that it'll take them out of the flow, take them out of the process. So let's have a look at, and I'm going to make the learning points. So just note here, this is this portfolio. It's obviously a small amount of capital because we start small enough to not fear and if you like, feel too much discomfort that it takes you out of the process. Enough that keeps you, that tests you, but not too much that it takes you out the process. So we've got 0 vacant positions, i.e. all 9, and we are 99.93% invested. Now, that's what we want to try and do. The first aim of any mechanical system process from a money management position sizing perspective and taking risk at an acceptable level is to get all your money in the market when you have had sufficient signals to do so. So we're running this portfolio at 9 positions. We want to get this as near as close as possible to 100%. So that's pretty good. Remember that 99.93%. And this now is the December US public portfolio, LTTP study group. And this got down to here, this histogram. So it went along okay. It didn't have minimal drawdown. And so this is going December, January, and into February. How are we coming into March? And here is the Trump tariff announcement, Liberation Day, as it was called, and we got down to just on 20% drawdown over here. So that's gone past the 15% drawdown. And since then, now we've got to trade out of that. So we've got to get all the way back up to 41,500 odd to in this portfolio before this histogram hits the zero. Now, this is where the learning point comes. Now we've got 10 positions. So we are fully invested from a position perspective, but we are only 88% of our money is invested. So we've got $4,000 cash here, which is obviously 12% or 11.74%. And that means that's of that. So we've got 4,000 of the available. So we've got cash, if you like. And so we haven't got all our money in the market over here. Capital allocated, 30,000, we should have $34,000 invested, allocated across the 10 positions. So we can't take another position here, even though we have sufficient cash to do that. So what's happened here? Why is this the case? And this is the learning point. Now, remember, this is a skills acquisition portfolio, not a profit acquisition portfolio. If it was a profit acquisition portfolio, we'd need to write in our trading plan what we do with these large priced stocks here. So Fair Isaac is a $2,100 stock. Melly is a $2,500 stock, and Netflix is an $1,100 stock. So what does that mean when you're trading with a relatively small amount of money? Is that you couldn't take a second position here. So you just took the first one at $1,900, which means if this is 10 open positions, roughly 10% in each portfolio, in each position, is that you want these here to be 9-10%, and we've only got 5.86% over here. And in that particular position, in Melly we got 6.9, and in Netflix, even though we got 2 in there, we got a quantity of 2 shares, it was still small relative to the position sizes that we were taking. So from a skills acquisition point of view, this is fine. So now we are learning, and this is to a degree a mistake in terms of not getting the money in the market. And so what would you do here? Well, you would modify if you only got that amount of money to trade with. When we go to investment plan, investing, actively investing for profit rather than for profit acquisition rather than skills acquisition. When you've gone through this process and you've got the skills, then you would either, and you've only got that amount of money to trade with, then you would exclude these stocks from your universe, your stocks universe. Or you would take another position to get the money in the market. Now, you don't want to get too many positions in the market, but or you could actually reduce the number of simultaneously open trades, which is probably what you would do, and so that you can get to and with a small amount of money, you could have 5, 6, 7 open positions rather than 10. And that is the way you would manage your portfolio. Now, obviously, with a lower number of simultaneously open positions, you are not going to get as many trades coming through. If you have a look at the app in the last 2 days, there's just been a whole ton of entry signals coming up. So there's sufficient opportunity to trade, and so people who've got a large amount of money, and our customers have got really large amounts of money to trade with, they can have more open positions and therefore get more of the trades coming through. But you don't have too many open positions, and because you don't want to get that, you don't want to have that percent invested too low either. So there's a balance that you have to get right over there. And what we found with the US is it's somewhere between 10 and 13 when you have sufficient capital. So that's the learning point here. The other alternative is to put more capital in. So those are the 3 choices you have. So when you move to your profit acquisition trading plan, investment plan, you have to just take that into consideration. Okay, now I'll get through these others really quite quickly. So this is the February Australian portfolio. It did get below 10% there, and it's which means criteria met. Now we want to trade out a drawdown, and that's the next challenge that we've got to do. ASX. Now, why is the ASX? You'll notice the ASX portfolios are close to 100%. Why? Because they've got lower price stocks, which means that the position sizes are more divisible, and so there are enough shares you can buy to get close to the position size that you want to get to. So 99.4% invested there. Now let's have a look at the February the US portfolio. Similar thing here. It's reached down to 20%. US portfolios of US market got hit a little bit more indices, and hence the positions in the stocks as well. So we got a trade out over here. So it's currently 11.59% drawdown, and similar thing, 93.5% invested. And why is that? Similar thing. We've got Fair Isaac and Melly, just one trade, 6% and 7% position sizes, and that's what's. So that means that you don't have enough money in the market. So we're getting this run up, and you want to have all of your money in the market to experience that run up, because the index always has all of its money in the market. So we want to, what we want to do is trade a subset of the entire index and get outperformance on the way up and the way down with our portfolios. That's what the edge is. Right, the March 31st or the beginning of April. So this portfolio has only been going for about 6 weeks or just under, and hasn't reached 10% drawdown yet. So the Learn to Trade Properly study group that started 6 weeks ago haven't reached the first objective to get into drawdown and trade out of it. And so that may take a while to do that. Where have we got to here? 9 open positions and 97, 98, or nearly 98% invested. And you would have had a bit of a ramp up over here to get the positions in the market. So I don't know exactly when. I could have put the number of trades on here as well, but it probably would have taken a couple of weeks, 2 or 3 weeks to get the money in the market to get going. Because remember, the index always has all its money in the market. Okay, let's have a look at the US portfolio. You can see also hasn't reached the 10%. It's only about minus 2.5% drawdown here. And it kind of missed this early April. So is that roundabout? Yeah, that's roundabout where the Trump tariff turmoil occurred, and we weren't in the market. So we got some headway on the market there by being mostly in cash. And so you can see when you start does have an effect on because what the market's doing at that time, and you'll never be able to pick because you don't know what's going to happen in the future, and nor do you need to know because anything can happen, but you got to get going on the process. And similar thing with this portfolio, because of it's only 91% invested, even though all 10 positions are in the market, so 9% not in. And similar thing, Fair Isaac, Melly, and Netflix are not full. Sorry, Fair Isaac is there, but Melly isn't. And so Melly's probably the main culprit over there, and Netflix to a lesser degree. So that's what I wanted to show you with the learning point. And I'll come to the questions in a moment. And just to finish off, I'm going to try and get into the half an hour with questions here. Is just two recent leaps, because we talk about, I've shown you the sells, and the sells there were relatively small losses in the last month. But a leap, if you like, a positive trade that's happening at the moment. This has been going since August last year, so it's gone right through the Trump turmoil here in April. And there's a breakaway gap. Is Take-Two Interactive Software. They do games, and that's now sitting at a 56% profit in the US market, and that's open in the leverage portfolio. And Melly, right across the board, it's in all the public portfolios and LTTP portfolios, is sitting at a 21% profit, and it's only 26 days. That's elapsed days, including weekends, and so that's a recent leap. Right, what I'm going to do now is go to questions if there are any. There's one comment by Bruce saying Regis RRL is a sell today, approximately 20% profit. I had a look at it on the open. And it's hanging about its close price from yesterday, so that'll be just over a 20% profit. Right, are there any questions there for today's session or about anything? Happy to take those. Just looking at the chats here, none there. So that's this month's portfolio considerations. Hopefully you got a good learning point out of that. Next week there won't be a session. The following week we'll do a monthly market update, look at status, look at where what's up with the markets, and we will do a little bit more analysis. So until then, thank you for your attendance, and I wish you consistent and objective active investing.